All right, welcome to another episode of Asset Coach and Tax Strategist. And so we're going to continue our series on economic termites. Today, we're going to talk about taxes. And so I'm not sure how long this episode is going to go, if we need to break it up into two parts or what. Taxes is a big dialogue. It's a big conversation. There's a lot to talk about. So what I'm going to try to do is just kind of narrow it down, but who knows? I'm just going to let the spirit flow and see what happens. And if we're feeling in the flow and we're just going to keep going with it. I just want to pour into you and give you as much information as I can. Now, remember, I'm not giving tax advice here. We're not giving legal advice. We're not giving investment advice or anything like that. This episode and all these episodes are just, this whole channel is for educational purposes only. The moment you become a member, you engage us, then we'll give advice and we'll go through that process. But right now it's just for information, high level. And so we're going through my book, Economic Termites. We're going to dive into that first termite that we're going to talk about, which is taxes. And so let me go ahead and share my screen and let's dive into exactly that. Chapter 4, termite number 1, taxes. Okay. And so we understand that the purpose of taxes is really to help the government run. You and I have services, you and I partake in services, whether they're roads, whether it's the military protecting us, whatever the case may be. Okay. Whether we agree with certain aspects of the government and how they're spending the money is a different conversation. And that's where we're trying to figure out what's our fair share. How do we calculate our fair share? What do we even know? It's, we rely on a tax professional, we rely on a financial advisor, we rely on insurance professionals, we rely. But it's about time we take control and understand some of the basics. You don't need to know everything about everything, but you need to know and understand the basics. And so that's what we're going to go through. And what we're doing is we want to talk about this tax liability. Okay, I say it right here, tax liability. This is a debt owed to the government in our partnership. So let's view this part and take this very seriously. The IRS, the government, is our business partner. Okay. Now, I'm not saying this from a facetious or their hands are always in our pockets type mentality. I'm actually trying to embrace this and actually get you to understand this from a business owner's perspective. The government is a business, plain and simple. They're in a business. They're in a business of running a piece of land and negotiating with other lands in contracts and treaties to work with each other. In order for the government to protect and to manage this land, these resources, they also need to generate revenue. And so the way they do that is through taxes, no different than kings did in kingdom time and monarchs and dictators do in other countries. In our republic, when the tax system began, it's designed to help support that business. The cash flow from each of us assets through our tax revenue it's taxes. Okay. So that's how the system works. Okay. Now, as our business partner, the government, Congress, the IRS, the collector of Congress, is designed to say, hey, we're going to give you some rules and guidelines called the IRS tax code, and we're going to encourage you to utilize this code to generate more cash flow. Now, it could be cash flow for the government. It could be cash flow for us. It depends on our understanding of this tax code, which is ever evolving and changing. Now, think about it this way. When the IRS, the government, gives you as a business owner the ability to deduct, to have rebates, to have certain tax incentives, and to have tax credits, these are 4 tax potential opportunities to generate cash flow as a business. Could the government say, you know what, we're going to tax your top line revenue? Absolutely, they could. Do they? No. What they say is you can have revenue, and then any cost of doing business, Section Code 162, any cost of doing business, you can deduct that cost as a expense from your earned income, your revenue, to where we'll tax your profit based on your entity structure. Plain and simple. Now, some states actually tax business revenue top line, but for example, the state of Texas, they'll actually tax your top line revenue. If you're a business that's over 15 million and more is when they start taxing your top line revenue. Below that, no. And that changes, right? And every state's different. And that's how they generate revenue, but they want to encourage businesses and So we need to understand from that perspective, what's this look like? So if you and I have these abilities to reduce our taxes, or basically not be taxed on top line revenue, but be able to deduct and have credits, incentives, rebates, and deductions, we have more cash flow. So the government knows that if you're a business owner, you have more cash flow, what are you going to do with it? You're not go spend it and buy a boat. Some do, and there's a tax consequence to that, right? There's a sales tax. The person who sold the boat earns a commission and they pay taxes on that. So even then, your spending generates revenue for the government through taxation. Okay. But the ideal thing is, as a business owner, we're addicted to our business. It's our retirement plan. And so what we're going to do is take this extra cash flow, put it back into our business to grow our business. And at some point, we can only wear so many hats as a business owner to where we hire employees, W-2 employees who have to pay taxes. You and I pay payroll taxes. They pay payroll taxes, right? Taxes on their income. There's Social Security that comes out of it that me, the employer, you, the employer, and the employee pay, and Medicare taxes. Okay. So we all pay taxes to keep the system flowing, right? So the more cash flow you as a business owner have, the more you can put in your business, grow your business, the more employees you can hire, the more revenue the government makes. They're investing in you as a business asset. They're not your silent partner. They are your partner. So let's not look at them from a very combative, but let's embrace the conversation, embrace it, and say, if they're a business and this is what they're looking for, how can I encourage that? Because you want your business to grow. You want profit. You want revenue, right? You want to have a lifestyle. You're in like mind with the government as much as you're. Now, here's where politics come in, and that changes things. So we're not going to get into that dialogue or that conversation. But from a basic understanding, as this is a relationship, this is a partnership. So in order for us to know how much we pay in taxes, the government lays that out. So that's what we're going to talk about. So let's look at and see how they do that. Well, the first thing they do that is through a income funnel. And I'm going to show, this is in the book, I'm going to show an easier one, because what I did was in this income funnel, when we communicate to our perspective and our members, we go through this conversation initially, okay? And this is an income funnel. The reason why we talk about an income funnel is that your W-2 income flows down this. Your K-1 income flows down this, and any other income that you generate through any other type of 1099 or asset flows down this income funnel. And your first 23 married filing joint, your first 23,200 is taxed at 10%. Then your next 23 to 94,000 is taxed at 12. And the more income you have, the more taxes you owe. It's called a progressive tax system. As you make more money, you progressively pay a higher percentage. So when all these politicians and all these talking heads say the wealthy aren't paying their fair share, they are. Now, they have more money. They may not be paying the same percentage because the tax system's different for each asset. What they're saying is they're not paying income like W-2 employees. No, of course not. Basically, they're talking out of both ends. Either they're so stupid they don't understand the system that they're running, or they're so smart they know it and they're playing us. I think it's the latter, which pisses me off, which is why my whole business exists. Why I have this channel is we need to know the game so they're not playing us, and the game's not playing us. We're playing the game. Okay. And so this is how we understand where we're at. So if I am making 300, let's say 500,000 in income, okay, I need to understand that if I'm making 500,000 in income, I'm in a marginal tax bracket of 35%. Why? Because 500,000 is between here and here. Now, only 500,000 to 487 is taxed at 35%. The remaining 487 to 380 is taxed at 32%, 24. And when you take the overall tax based on your 500,000, that's your effective tax rate. So when you go to your CPA and say, what's my tax rate? They're going to give you the effective tax rate. They're not going to give you your marginal rate, because their job is to tell you what you're paying in taxes, not how to save in taxes. So the reason why we talk about this income funnel is that if we're not allowing certain K1 or certain profits, or we're doing tax planning and we're minimizing the amount of income flowing down here, what's that mean? That means we stop paying higher tax percentages and we pay lower. And I'm going to show you how we understand that and dictate that. So this is the married filing joint. And then of course, the single filer has, the numbers are different, but the percentages are the same. The numbers vary from each one. Okay. So this is the what we call the income funnel, to explain how the progressive tax system works. All right. Now, this is based on your 1040 taxable income. So it's important to understand that and how that flows and what that just looks like. Okay. So it's very important as we go through this process, we understand, and we go through this process by going through calculations. All right. So now over here, and the reason why I'm using an Excel spreadsheet is because most people understand Excel. If I were to throw it down a software and start going through a software and explaining a software, most people aren't going to understand the software. Okay. So I'm trying to keep this as simple as possible. This isn't 100% accurate. Okay. It's not to the penny, but this gives you a good understanding of how the progressive tax system works. Okay. And then, of course, hey, if I have total taxable income, what do I actually need in my lifestyle? And this is what we call the cash flow recovery, okay? Is where we figure out what income do you have or you're making and you're paying taxes on, and what do you actually need? So if you're not sure what the cash flow recovery is, go in the link below and go ahead and sign up to schedule a time with one of my coaches. One of my coaches will set up a 15 to 30-minute conversation, walking through your numbers and giving you what we call your cash flow recovery number. Okay, that's this here. Okay. All right. So, and what that means to you. So let's look at this. Let's say you make $350,000 a year. Okay. What that means is that you're going to be paying $10,000, $34,000. And then in this tax bracket, between here and here is $350,000. So 148 of your income is taxed in the 24% tax bracket. So what we're going to do is we're going to tally these two up, and that is what gives us our tax. Okay. So now what we want to do is say, okay, well, what if I really don't need that? What if I actually need less? Well, then we got to understand what that less looks like. So if it's 240, meaning that's your lifestyle expenses, meaning your lifestyle income, meaning that's what you need to live your lifestyle, whatever that is, then that's $110,000 that you're passing through that income funnel, paying taxes on, meaning an extra $26,400 just federally, that you don't need to. This is your fair share. So again, we calculate all this. Here's your fair share. You should be paying closer to this, not this. You're overpaying by $26,000. Imagine if you had an extra $26,000 growing to your lifestyle on an annual basis. And that's what we talk about in Economic Termites in the book, when we go down and we start talking about here's the tax brackets, and we start going and talking about what this looks like in your situation. I just went through all these calculations, non-appreciable, appreciable deductions. Okay, so we just went through your income, your lifestyle expenses equals your non-lifestyle expenses. I just showed you the profit and loss statement that we do as a business owner. I just went through it for you as an individual. So when we go through the income funnel, now we're talking about opportunity costs. So this $26,000 that we were just talking about, if we did this over the next 10 years, that's $264,000, $250,000 extra you're giving to the IRS, above and beyond your fair share. You want to know that. So let's take it a step further. So let's take a look at the 350. here's your federal income tax. This is your effective rate, but here's the actual tax number, right? 70,840, 70,840, 084, sorry. Here's your Social Security tax you pay on that fund, on the money. Here's your Medicare tax. Now, Social Security tax is capped at $168,600 based on the time of this recording in the year 2024. Okay. Now, so it's capped. So here's your Medicare, here's your total tax. So it's not just 70,000, you're paying 85,000 to the government through your payroll. Okay, so now you have a net of 264,000. Okay, so now let's go over to the right and say, no, I only need 240. Okay, well, do you? Now your tax rate's down to 43. We still have the 10,000 to Social Security. We have Medicare. Oops, this formulation. Sorry, folks, that caught that. Look at that. That's why we do this. We go through this. So it's 57,000. So you have an extra 182,000. What's the difference between these two? Well, this is Excel, so let's calculate that. That minus that equals 27,994. Okay, so this is actually your extra that your extra taxes you're paying on. But here's the thing. Here's the thing. Remember in this brief calculation, we said 110, right? This is just an overview. Now we're getting a little more nerdy. We're looking at Social Security tax, right? We're looking at not just Social Security tax, but now we're looking at Medicare tax. This is your share, not the business's side. We're looking at how much you're paying taxes, how much you are saving, what your net of taxes. And then we say, okay, then we have extra taxes. What's extra taxes? Well, these are the extra funds. So if I were to subtract these two things, okay, so I have 62,000. This is my sales tax, gas tax, sins tax, property tax, capital gains tax. Could these be additional taxes from purchasing, buying? We don't know. This is just, again, this is an overview. What we do in our practice is to fine tune this area here. Is we actually go through the last 12 months of your personal bank statements, and my bookkeeping team will break down each month your spending and income to get to your income need and your expense need to find out what your fair share of lifestyle income you really need. And we'll do one step further is we'll break it down into the months into halves. The first part, so the 1st to the 14th of the month, and then the 15th to the end of the month. Why do we do that? Because there's certain expenses that we have that fall in the first half of the month versus the second half. So understanding our income cash flow and our expense flow lays out how we map our cash flow. Okay, so we want to map that out so we can predict what do you actually need. Maybe you don't need 240. Maybe you actually need closer to 182. What's that look like? So we want to get closer and closer to this because what's it do? It saves you money on taxes. And if we're able to save you money on taxes, that money can go back to your wealth. And imagine if you were able to, I'm going to get my financial calculator. No, let's just do it right here. Okay, so let's look at this. Let's do a function of future value. Okay, and so let's say that we earn a rate of let's just say 5%. Okay, let's be very conservative over the next 10 years, and our payment is the 27,995, and we end up present value 0. What's this look like? Whoop. A little bit too much. Sorry. There we go. Okay, so that's a big deal, right? That's a very, very big deal. We're generating in effect, I'm just putting a negative there so it doesn't look like we're losing money. So this 27,000, let's call it 28, over 10 years at just a 5% rate of return, and current CDs and money markets are paying 5%. You know, a year and a half, 2 years ago, 5% was like, well, you're stretching it, Bob. Now interest rates and inflation has caused it. Will it stay that way? I have no idea. But Either way, you can still get 5%. You can get 5% from a whole life policy. You can get 5% based on dividends and interest from your investment portfolio. There's ways to get 5% very simply. Okay. So, which is why I use the number 5%. I'm not using stock market rate of returns. But, anyways, look at that. So, if over the 10 years we used our tax savings, that's an additional $352,000 of wealth to your wealth. Imagine in that year 10, we use that as a down payment to buy a piece of property, a real estate property. Okay. And that piece of property is worth, I don't know, let's say $1 million. Wow. Take a look at that. Well, all of a sudden, what happened was that your tax savings over 10 years created 352,000 that was able to create $1 million in value. Right? So crazy. That's what taxes do. That's the opportunity cost to taxes. That's what we're talking about here. I mean, we're not going in as much detail in the book as I just did, but that's pretty spectacular, right? So when you're looking at these figures and going through the book, you got to understand what's this mean to me in my lifestyle. If I need to dive into this and be a little more specific, well, Bob, that sounds like a lot of work. Does it? Is that worth $1 million? Right? What if we were able to lower this number? What if we were able to lower this number? What would that look like? What if your 240 actually was 180? Okay. So now all of a sudden, we're no longer in this tax bracket. We're in this bracket. And all of a sudden, we got to go through and we got to look at what our actually tax liability is here. And so how are we saving money there now? And understanding the aspects of those two scenarios. So now we're at 29. So now look at our situation. It's a lot lower. Now it's at 42,000. Imagine if I actually didn't do this, I just did that. There we go. We made another 200,000. Is that worth it? And this 500 actually can buy you a piece of property that's closer to $2 million. If we're talking about real estate, and that real estate kicks off, I don't know, another $30,000 a year in income. Could that be possible? Absolutely. And if this creates income, do you need this much income from your business? I don't know, but you get the point. That now we have $30,000, we have $42,000 in tax savings. That's $72,000 of value by just being a little more understanding and specific of your situation. That's what we do. Now, in our Terra Firma members starter kit, kind of our beginning part, we actually will walk through this. We'll help you walk through this on your own so you can do this stuff on your own. Most people, truth be told, will reach out to us and say, hey, we want to pay you guys to do this. But at the end of the day, this is why it's so important to understand this termite of taxes. Because when we understand the termite just from an income perspective, imagine all the other expenses. Maybe imagine the sales tax, right? It could be anywhere from 6 to 9% additional on money that you were already taxed on. You paid income taxes on. This is your net money. Now you're going to pay another 6 to 9% on that. If you have property taxes to your dwelling, you're going to have that, right? If you decide that you want to invest that piece of property, you sell it, you make money, that profit, you're going to be taxed 15 to 20% on that, right? So the government's very good at generating revenue, but they can only generate revenue based on you and I as business owners being effective and smarter with our business. Does that make sense? So hopefully this was helpful. And hey, add comments down below. Again, we're not talking to the pennies here, right? I'm giving you concepts and ideas to think about from a global perspective. What does this mean to me from a dollars and cents? I'm a business owner. I hear people talk about tax savings, and I hear people, and I don't know what that means. It just seems complicated. Well, I try to go in the weeds a little bit, but stay high level at weeds. We're looking at the top of the weeds, not the roots of the weeds, right? And understanding what's this mean to me from a value perspective, a dollar and cents. And I'm just talking about someone who's making $350 a year who doesn't need all that money. Right? How do we effectively do that? We have strategies to do that. We can show you how to do that. And it's not creating a retirement plan. It's not tying up money till retirement. It's not giving more money away to charity. It's not, going to buy a new car or, all these other strategies and ideas that CPAs tell you. No, that's not productive capital. That's capital that's being tied up in things and other stuff. That's not right. As a business owner, you want your capital working, you want your money moving, not tied up someplace, right? You can earn a greater return as a business owner than in your control and more predictive than relying on something else. Okay. Now we do want to use other assets to support what we're doing. So, but that's what we need to understand. What couple tweaks do you need to make in your business to change your business from a $3 million revenue business to a $10 million revenue business? A lot of times it's just a couple little tweaks. That's it. But it depends on your situation. So hopefully this was helpful. Again, taxes, huge expense line to us. It is a liability unless we turn it into an asset like we are. The only way you turn it into asset is by knowing the rules, understanding how the flow of cash and how the income funnel works and how these assets are each taxed differently. Okay, so we just talked about you as an asset in W-2. Imagine once we start going through all these other assets, how we're able to compound all this knowledge and information, and all of a sudden we have an extra 72. We may end up having an extra 150,000 of cash flow and revenue in our pocket going to each year to building our wealth. Okay, because now we have access to more of the tax code because we have more. That's the key. The less you have, the less access to the tax code you have. That's why the rich get richer. It's because they have more access to the playbook, plain and simple. They have better athletes, so to speak. So have a blessed day. Thanks so much.